Hi, I'm Derek Carmichael of PwC Global Accounting Consulting Services, and welcome to another edition of Analysing IFRS 16 Leases. Today I'm joined again by Holger Meurer. In our previous editions, we focused on the impact that IFRS 16 will have on lessee accounting. However, we haven't yet looked at the lessor side. Holger, what effect does IFRS 16 have on lessor accounting?
Well, thanks, Derek. IFRS 16 primarily focuses on lessee accounting. For lessors, it stays almost the same as under IFRS 17. So the lessor still will have to make the distinction between, on the one hand, operating lease and finance lease, based on the extent to which risk and rewards have been transferred to the lessee. The indicators it uses to make that distinction they are the same as under IFRS 17. So, for example, it would still have a look at the present value of the lease payments and compare those to the fair value of the underlying asset. Or it would look at the lease term and compare that to the economic life of the underlying asset. So this almost stays the same, and then if the lease is classified as an operating lease, the lessor would continue to recognize the asset and recognize lease income on a straight line basis, whereas if it's classified as a finance lease, he would de-recognize and recognize a receivable at an amount equal to the net investment in the lease.
So does this mean that lessors don't really need to care about IFRS 16?
Well, that's not quite right. I mean, the mechanics for the lessor, they stay the same as said before. However, there are quite a number of topics, in particular those we've discussed already before for the lessee, who affect both lessee and lessor. So just for example, the definition of a lease is the same for both for lessor and for lessee. Also, terms like lease term or lease payments are defined in the same way for lessor and for lessee. And so, for example, whether an extension option or termination option is taken into account when determining the lease term, or whether variable lease payments are taken into account, this both affects both parties, lessee and lessor. I mean, other examples are separating contracts or combining contracts. That's also an area by which both parties are affected.
Are there any other changes that are relevant for lessors?
I think one point worth mentioning is the classification for subleases. So when an intermediate lessor classifies a sublease, it no longer refers to the underlying asset, as it currently is done under IFRS 17, but instead to the right of use asset resulting from the head lease. So, for example, if it does the present value test, it compares the present value of the lease payments from the sublease, but not to the fair value of the underlying asset, but instead to the fair value of the right of use asset. The same is with the lease term. The lessor compares the lease term of the sublease, but not to the economic life of the underlying asset, but to the economic life of the right of use asset, which actually is the lease term of the head lease. So there is quite a difference, and in particular, as the fair value of the right of use asset will normally be smaller than the fair value of the underlying asset, it's more likely that it now will end up in a finance lease.
Thanks, Holger. So I think it's clear that IFRS 16 does have some important changes for lessors. Aside from this, we have previously talked about how IFRS 16 will have a significant impact on lessees. What impact might this then have also for their negotiations with lessors?
Well, I think it will have quite a significant impact because now under IFRS 16, the lessee would recognize a right of use asset and a lease liability for almost every lease contract. So it no longer matters to him whether it's classified as an operating lease or as a finance lease. Instead, he will focus much more on whether the contract meets the definition of a lease contract at all. And if it's a lease contract, he will try to minimize the lease liability, for example, by excluding some of the variable lease payments. So I think this will be much more in focus now.
Okay, so turning to transition for a moment, IFRS 16 lessor accounting, since there are a lot of similarities with IFRS 17, I assume that the transition requirements are actually quite simple.
Yeah, I think that's quite right. I mean, for the lessor, he's not really required to do any adjustments, so there's not much for him to do. He just applies the new guidance prospectively, starting from the date of initial application. The only exception are subleases. As mentioned before, there can be a difference between 17 and 16, and therefore for those subleases that were previously classified as operating leases, they now have to be reassessed, so they might end up in a finance lease, and if that's the case, the lessor has to recognize a new finance lease from the date of initial application.
That's helpful, Holger, and I think it does also make it clear that while a lot of the attention for IFRS 16 has been focused on the impact it has on lessee accounting, there are quite a number of effects it will have on lessor accounting, and also actually potentially in commercial negotiations lessors then have with lessees. So thanks for sharing. For more on IFRS 16 leases, we do have a range of other videos available, as well as a variety of publications that are available on PwC Inform. Please reach out to your local PwC contact for more information on how to access these. Thanks for watching.